And for more on the state of the U.S. economy, let's bring in William Lee. He's chief economist at the Milken Institute. William, thanks so much for coming on.
Hi, Karina. Good to see you.
So, William, can we start by just getting your reaction to the rise in third quarter GDP, 3.1% compared to 3% in the second quarter, boosted in part by consumer spending once again, but also exports and business investment. And where does it go from here in 2025, in your opinion?
That's part of the U.S. story for the year, which is to say good news and bad news, but coming in with greater extremes. The above trend growth and 3% or better than 3% is something that most economists would consider that extraordinarily strong growth in the United States. Normal growth is something on the order of 2%. So we're well above that. And it's being powered by consumers. And unfortunately, it's powered by extremes in consumption. The very wealthy who are able to tap into savings because of the huge amount of stock market gains they've had, well, they can spend easily. But remember, Donald Trump was elected because so much of the U.S. population, so much of the electorate are barely going from hand to mouth, paycheck to paycheck. And those people are feeling the extremes of inflation. So we have an economy of extremes where the very well off who are able to have stock market wealth, and that's about 20% of the population that owns 75% of stock market wealth, they're doing quite well. But the other three-quarters of the population are not doing as well. And I think when we go to going forward is these extremes cannot persist. We're going to have to do something to close that huge amount of income and wealth gap in the United States in order to really make the U.S. economy more robust. Because right now, the huge amount of vulnerabilities is in those extremes, and it shows up in inflation. The inflation that we see is from the supply constraints that we had during COVID, but those have eased off now. And the source of inflation that the Federal Reserve is worried tremendously about is service sector domestic inflation, even excluding housing. And that's where I think we're going to have to be watching going forward. Where will that inflation turn down? Auto insurance, medical care, education, those are the kind of expenses that seem to be persistently high that are hitting people's wallets.
Yeah, exactly. And closing that gap is not going to be easy. Now, imports, which are a subtraction when you're calculating GDP, actually increased in the third quarter. What happens there if we see Trump tariffs imposed?
Well, actually, I am among a group of economists who believe that the Trump tariffs are sort of the headline number, the headline discussion. The agenda that President Trump got elected on was make America great again by bringing back more jobs and high-paying jobs. I think we're going to see that our trading partners will be faced with the following question. Can you do something to invest in the United States? If you can, the tariffs will be a trivial issue for you. In fact, you can even escape tariffs. You'll even get tax subsidies if you invest and create jobs in the United States. But if you don't, if you insist on importing the stuff and producing it abroad and not producing in the United States, you'll be facing a serious amount of tariff in order to really help our own domestic industries. And I think that's the choice that's being faced by a lot of foreign countries, U.S., Europeans, and countries all around the world. And President Trump is trying to say to both friend and foe, please invest in the United States and you'll be a great friend. You don't invest in the United States, and I'm going to be putting you on the unfriendly list.
We'll have to wait to see what happens there and whether he follows through or not. Now, federal government spending also contributed to GDP growth in Q3. How does that change when DOGE starts cutting the wasteful government spending that it promises to do?
Well, that's a great question, Karina. Everyone seems to have great hopes for DOGE to be able to cut back on the amount of government expenditures, but the amount of discretionary expenditures that's really available to be cut back on is very small. And things like interest expenses, which is a spending component of the U.S. government because of the extreme borrowing they've had, that is larger than the amount we spend on all of defense. So the real problem would be entitlements, and that has become the third rail of American politics. No one's willing to deal with entitlements. So yes, I think people are optimistic that there'll be efficiency, but the amount of efficiency gains will be relatively small unless there's some extreme structural changes done to the size and structure of the U.S. government. Elon Musk and Ramaswamy both believe they can make such huge structural adjustments. A lot of people doubt that.
Interesting. All right. Now, William, I'm really curious. What is your referendum of how good a job the Fed has been doing? Its decision to cut rates by 25 basis points, so 1% in total this year, given that labor is strong, unemployment is relatively low, and inflation is creeping higher. And Powell's comments that it now foresees fewer cuts next year.
Well, Karina, what a great question. I'm asked that question by some of our most sophisticated sponsors and investors at Milken. And my answer is the following. The Fed has been doing a fantastic job because they really have tried to deal with things they can deal with and leave alone things they cannot deal with. The Fed controls the very short interest rates, the short end of the market. And because they've been so high, banks have not been able to make loans to small businesses and companies that are dependent upon borrowing money to expand their businesses. And so that's why the Fed really wants to lower its rates. But because inflation is still very high, they can't lower it to the point where people's expectations of future inflation start to grow. So they're really on the knife edge where they want to lower rates to help small businesses and banks, but unfortunately, they have to be able to be very careful and convince people that we're not going to go crazy printing money and keep inflation expectations low. And whereas the long end of the market is going up because people don't believe inflation is coming down as fast as the Fed wants it to come down, and we may not reach a 2% target for several years. And that kind of fear is causing the long interest rates to go up. So we have this kind of switcheroo going on where the Fed is lowering short end, but the long end is going up, and mortgages and other long-term loans are not being helped. Meanwhile, the stock market is doing very well. So we have these extremes in the financial markets, and so my grade for the Federal Reserve is what they can do in terms of lowering rates to help banks. They're doing a fantastic job helping small businesses. What they cannot do is to lower long-term rates because that's a function of how people perceive the strength of the U.S. economy and future inflation. And right now, that's kind of highly uncertain.